My agenda will be based on a simple core principle: putting America first. Whether it's producing steel, building cars, or curing disease, I want the next generation of production and innovation to happen right here on our great homeland, America.
In 2016, he was only able to make campaign promises. 4 years later, the question is, how many of those has he managed to keep? More importantly, what has the presidency itself meant for the economy and the financial markets, and what might it mean going forward? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. Like it or not, it's a fact that President Trump is heading into an election year as only the third commander-in-chief in U.S. history to be impeached. On the other hand, he's very unlikely to be removed from office by the GOP-controlled Senate, and polls suggest he still has a very good shot of getting reelected come November. It's also a fact that the president is probably the most controversial and diverse U.S. president in modern history, so much so that even discussing him can be tricky business at times. However, it's important where your retirement savings are concerned. Why? Because many economic and geopolitical forces that impact the financial markets are influenced to a large extent by a president's policies and by a president's actions. So with that in mind, today we're going to take an impartial look at the president's various achievements since November 2016 and how they've affected markets. We'll also discuss some of the major promises that he's failed to keep and what his reelection or defeat in November could mean for the markets moving forward. And joining us today will be Peter Morici. He's a professor at the Smith School of Business at the University of Maryland. He's also a former chief economist at the U.S. International Trade Commission. Along with Jeff Small, president of Arbor Financial Services in Melbourne, Florida, he is also the brand ambassador of our very own retirement income store. But before we examine President Trump's economic record specifically, let's first discuss some of his most noteworthy successes overall. It didn't take long for the president to make good on one of his biggest and most impactful campaign promises. His Tax Cuts and Jobs Act, which cut taxes for individuals and particularly corporations, was signed into law on December 22, 2017. Now, while the law remains controversial and passed with no Democratic support, its impact on the economy and the financial markets has been significant. In fact, it was so significant that the president's staff and supporters typically point to it as the key victory of his presidency. In strictly political terms, that may be accurate because the economy is often on the minds of voters when they head to the polls. If certain sectors of the economy that have benefited from the tax cuts, namely the stock market and job growth, if those sectors remain strong heading into November, that might be all the president needs to secure a second term. Let's review some of the Trump administration's successes not directly related to the economy, bearing in mind that almost everything a president does has the potential to impact the economy and financial markets in some way. Now, without question, President Trump's most lasting impact on the country will be his reshaping of the federal judiciary system. So far, he has installed 2 Supreme Court justices and 187 judges to the federal bench, all for lifetime appointments, and appointed 50 judges to the 13 circuit courts. As everyone knows, these courts and judges set legal precedents that can shape the country for decades to come. Naturally, the president's detractors hardly consider this a victory. However, strictly in terms of making good on his campaign promises, it is another huge win for the president, who continually touted law and order as being among his top priorities. In that same vein, another of the president's biggest victories took aim at the criminal justice system, and as hard as it may be to believe, was actually the result of a bipartisan effort. In December of 2018, the president signed the First Step Act into law, marking the first legislative win in years for advocates seeking criminal justice reforms. The bill, which mainly addresses a need for sweeping changes in the federal prison system, passed with overwhelming bipartisan support in Congress. Lawmakers on both sides of the aisle continue to use it as an example of how, yes, it's still possible for government to work together, even in these highly divided times. Another recent victory for the president, despite many jokes about it initially, was Space Force. President Trump officially established the sixth branch of the U.S. military, the Space Force, signing a $738 billion defense spending bill just before Christmas. It's the first new military service since the Air Force was created in 1947. Now, despite its name, Space Force wasn't created to defend the planet against attacks by space aliens or anything like that, but instead to protect the U.S. military's assets that are currently in space. Finally, another major victory for the president involves his promises around national security and vows to take a hard line against terrorist groups, particularly ISIS. In fact, in late October, a U.S. raid led to the death of ISIS leader Abu Bakr al-Baghdadi, who was the world's most wanted terrorist up to that point. His death dealt a major blow to the terrorist group and was another major win for the president, who said capturing and killing the ISIS leader was the top national security priority of his administration. Yet, despite these and other smaller victories barely covered by the mainstream media, by far the president's biggest wins have been directly related to the economy and financial markets. We'll talk more about that shortly and look at some aspects of the president's economic policies whose success or failures have yet to be determined. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more. And right now, it's time to welcome our first guest, Peter Morici, a professor at the Smith School of Business at the University of Maryland. He's also a former chief economist at the U.S. International Trade Commission. You can follow Peter on Twitter at pmorici1. Peter, thanks for joining us today on the show.
Well, nice to be with you, always.
So you're a professor. You're used to grading and evaluating people, right? So, okay, let's grade the president. How's he done economically? Even things that he did directly for the economy and indirectly so far in his term.
Well, we got the tax cut, we had the deregulation, we had the changes in the courts, which are very, very beneficial to the economy long term. And we have the 2 trade agreements, the Mexico deal and today the China deal. Overall, I give him a B. He's done a lot of needless upsetting of our allies and people that could cooperate with us regarding the Chinese. He hasn't got a lot done on middle-class issues, the kinds of things that might count in the election. You know, things like college tuition and student loans.
So we talk about consumer spending, though, being at, really doing very well. So doesn't that help the middle class also?
Well, sure it does, but I don't know that it's enough given the president's negatives. You know, the way people regard him and his past behavior. I mean, we have to acknowledge that this is a very unusual presidency. It's the sort of thing that happens every 50 or 100 years. It's very much like the presidency of John Quincy Adams, where there was a lot of institutional opposition in Washington. And so that affects how people perceive him. You know, it's hard to have more favorable ratings when you get a constant drumbeat from Bloomberg and the Wall Street Journal about his limitations.
What do you think at this point about his chances for successful re-election come November?
Well, I think that if the election were Valentine's Day, he'd be in pretty good shape. His problem is the election is in November, and we're going to feel in the first quarter and into the second the impact of the Boeing problems. Boeing is a huge, it's the elephant going through the snake. It's going to create huge reverberations through the economy in terms of growth, wages, and so forth. And unfortunately for Mr. Trump, the economy may be recovering in the third quarter and may have recovered by the third quarter, but he won't have that data going into the election. You know, we don't get third quarter data until the end of October.
Right, right. So in the 1 minute we have left, then, what do you think he needs to do to have the highest chance of getting reelected?
I think he needs to come up with a middle-class agenda, something more substantive on prescription drug prices, college tuition, childcare, things of that nature. There's stuff there that really could be done, that needs to be done, and the Democrats are coming up with proposals, and the Trump administration is not.
Okay, so the economy needs to keep going, and if the economy keeps doing well, that's good. He has to do some things structurally for the middle class to help them. And 20 seconds left in the segment, what's the biggest thing that could derail him at this point beside the economy?
Oh, I think that if the impeachment hearings went the wrong way, if the Democrats put up a moderate candidate, a genuinely moderate candidate that had a platform, that would mean Joe Biden would actually have to have a vision. I don't think there's anybody else on their side that's moderate, but I think that Biden could give him real trouble.
Okay. All right. Peter, stay with us. We need to take a commercial break. You stay with us too. We'll be right back here in a moment on the income generation.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Three years into the presidency, Donald Trump's signature legislative achievement remains the Republican tax bill that made sweeping changes to the tax code, aka the Tax Cuts and Jobs Act. The law was the biggest overhaul to the nation's tax code in 3 decades, permanently slashing the corporate tax rate from 35% all the way down to 21%, while also providing temporary benefits for individuals and families. On the campaign trail, the president touted his tax plan as rocket fuel for the American economy and a great improvement over the steady but slow economic recovery efforts of his predecessor. Has it been that? Well, in some ways, the answer is yes. As of December, the economy under the president has created at least 100,000 new jobs, according to the White House, and has added new jobs in every month since his election. There's little doubt the president's pro-growth policies have helped create a higher demand for labor, and that they largely contributed to the nation's lowest unemployment rate in 50 years. At the same time, wages have risen again under President Trump after being stagnant for years following the financial crisis. Nominal average hourly earnings increased at a 3.1% rate year over year, according to the White House. And real wages have increased at a year-over-year rate of 1.9% when taking inflation into account. And that's all great. But what about growth as measured by the GDP? Well, so far, the president's rocket fuel hasn't proven to be quite as effective in that area. Now, as you might recall, the president vowed that his tax cuts could result in GDP growth hitting 4% or even 5 or more. For a while, it looked like that might actually be possible. Following his election and even before his tax bill was actually signed, real GDP growth leapt from 2.2% to 3.2%, and then to 3.5% by the last quarter of 2017. It hit 3.5% again in the spring of 2018, but then fell all the way back down to 1.1% by the fourth quarter of 18. Overall, since the tax cut went into effect, growth has averaged about 2.5%, which is about the same as recorded in the 6 quarters before the tax cut had been passed. Of course, one economic indicator that does appear to have been injected with rocket fuel right now is the stock market, which enjoyed its best year in decades in 2019, with all 3 major market indices hitting multiple new record highs. The Dow Jones Industrial Average finished the year up 22.3%, and the S&P 500 was up 28.9%. The Nasdaq grew by 35.2%. From the start, the president is taking great pride in the stock market's performance under his watch, although in truth, the market's ascension to its current heights has hardly been rocket-like. After rising steadily throughout 2017 in anticipation of the tax cuts, the stock market stalled in January of 18 and ended up 2018 with its worst December on record since the Great Depression. And as I noted on a previous show, even as recently as early October of last year, 2019, the S&P 500 was only 80 points higher than it had been in January of 2018, almost 2 years prior. And the Dow was actually only 600 points lower than it had been at the beginning of 2018. In other words, most of the stock market's latest gains have occurred really in the last few months of 2019 and have largely been a result of big investors focusing on just a few things. The main thing they've been focused on is that a deal is moving forward to de-escalate the U.S.-China trade war. Now, obviously, I haven't mentioned the trade war yet on the show, and because of that, you could argue it's been the proverbial elephant in the room in a discussion about the president's wins and losses. However, that's because the jury, if you think about it, is really still out as to which category it might fall into. And we'll talk about that more, as well as some of the other main questions and hurdles that the president will be facing as November draws closer, all coming up in just a moment. Right now, let's welcome back Peter Morici, professor at the Smith School of Business at the University of Maryland. He's also a former chief economist at the U.S. International Trade Commission, and you could follow him once again at pmorici1. Peter, thanks so much for sticking around.
Nice to be with you again.
So it sounds like you've got some real concerns about the economy being able to maintain this growth in the second half of the year. Is that correct?
No, it's really the first half coming up. It's that we're now in. My feeling is that the Boeing thing is going to hit pretty hard, and that's going to take a little bit of the momentum off. I'm not worried about a recession, mind you, but I'm worried about progress in terms of jobs, wages in particular, because of the labor market softening as the layoffs extend through the Boeing supply chain. Now, on the positive side, the trade deal with China might start to kick in, but I don't know how fast that's going to matriculate. I don't know how fast the Chinese can really ramp up what they spend over here. $100 billion is a lot for the government to just point a finger to businesses. They buy $100 billion worth of stuff, even in China.
Yeah. So let's talk directly to our viewers, our income generation members, those over the age of 50, who hopefully at least are starting, if they haven't already, to make the transition in their portfolios from growth to income. What would you tell them for the best advice for 2020?
Well, you should have a target date for retirement. On the day you retire, a good benchmark is 50% fixed income, 50% equities. Now, you can have more in equities depending on the size of your portfolio. Another question to ask is, in your fixed income, it doesn't all have to be cash. It can be in a ladder. Do you have enough to last you 5 years? Because you don't want to be caught in a situation where you're selling stock if the market decides to go down a lot the year you retire, adverse sequence of returns. So if you have a 5-year ladder, you should be okay.
Yeah, and it makes sense because it has to do with how much your income needs are determining your allocation. But on the other hand, the reality of it is today the income on some stock portfolios can match, maybe even exceed the income on some bond portfolios.
If you can get along on 2% of your portfolio as a retirement income, you're cool. Just put it in the S&P 500. That pays about 1.9. It's going to be hard to lose too much. But if you have to sell securities to live, not just live off the interest and the dividends and so forth, you don't want to be in a situation of selling a large number of securities or a large share of your portfolio when the market's down. You don't want to be selling 8% of your portfolio to get 4% for income.
Well, and our regular viewers hear me say week after week, don't put yourself in a situation where you have to sell, i.e. use the liquidation method to fund retirement income. So hopefully they're not doing that. But because they have half or maybe even some cases more than half their assets in fixed income, let's talk about interest rates over the next year or two. You think we're to stay kind of in a narrow channel, let's say on the 10-year Treasury between 1.5 and 2? Or do you see any major changes in one direction or another at this point?
I don't see a major change in one direction or the other. I would say this: if people are retiring with more than half in fixed income because they're going to need that in 5 years, then they shouldn't be retiring. They should work some more. I really feel that if you're not going in with at least half in equities and comfortable with that in terms of your medium-term needs, 5 years, 7 years out, then you got a problem. I mean, it's a very risky proposition.
So even with the Boeing issues, in the 20 seconds we have left, even with the Boeing issues then, it sounds like you're not predicting a major stock market pullback, maybe a small correction, if you will, but not a bear market per se. Am I interpreting you correctly?
Well, I'm not anticipating a bear market. I think the market will survive Boeing very nicely. It's probably already factored it in. My feeling is the market's heading up this year, that we're going to have enough growth to support, a 10% increase in equities in 2020. It won't be 2019 again, but how many years do you get 29% years in a row or something? You just don't.
Of course, and hopefully 2020 doesn't prove to be a blow-off top, which is my concern. So Peter, thanks so much. I really appreciate you being back on the show. Yeah. Thank you.
Take care.
And you stay with us too. We'll be back here in a moment, coming up with more on the income generation.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementinComeStore.com.
Immigration and the border wall, foreign policy and our NATO alliances, repealing and replacing Obamacare. These are some of the major areas where the president's policies and efforts not only have been the most controversial, but have also fallen short when compared to the campaign goals and promises. The good news for the president is that his staunchest supporters have remained loyal and stayed largely focused on his economic achievements. Undoubtedly, though, the president's most controversial and challenging efforts have been those involving trade. Why? Because his trade policies and decisions have undercut his otherwise strong economic performance. As everyone knows, the trade war basically kicked off as a war of words between President Trump and Chinese President Xi Jinping. However, even on the campaign trail, the president was vowing to take a hard line on trade and to renegotiate trade deals that he saw as harmful to the United States. From the start, there was little argument from either side about the need for addressing the U.S. trade imbalance, though the president's approach to the problem has caused a lot of argument. And many economists issued staunch warnings about the potential dangers of a trade war even before the first tariffs were actually imposed. That happened in March of 2018. And since then, the Trump administration has placed $550 billion worth of tariffs on Chinese goods. And China has countered with $185 billion worth of tariffs on American goods. The result, at the very least, do seem to contradict the president's famous tweet that trade wars are good and easy to win. Several recent studies on the impacts of the trade war have reached the same conclusions, that it has damaged both the U.S. and Chinese economies, as well as contributed to global economic instability. A report by the National Bureau of Economic Research estimated that by the end of 2018, the trade war had already cost U.S. consumers and companies that import foreign goods an additional $3 billion per month in added tax costs, and another $1.4 billion in efficiency losses. The trade war has been blamed for a sharp decline in business investment and bilateral trade, higher prices for consumers, and a slowdown in the manufacturing sector that the American Trucking Association and others have classified as a manufacturing recession. Now, as you probably recall, reviving the manufacturing sector was another of the president's campaign promises, and in the first year of his presidency, he was very much delivering on that promise. Manufacturing surged in 2017, then started to slow in 2018 before heading into a steady decline somewhere in the middle of 2019. In December, the PMI manufacturing index fell to its lowest point since September of 2017, indicating a dip in confidence among executives about how their businesses will perform in the new year. Many economists say this could be an ominous sign. And the International Monetary Fund has actually warned that the global economy is already in what they called a synchronized slowdown, in part due to the impacts of the U.S.-China trade war. Unfortunately, this does not square with the soaring U.S. stock market, but that doesn't mean what we're seeing on Wall Street isn't also linked directly to the trade war. As I pointed out, the stock market was in a nervous holding pattern for all of 2018 and a good part of 2019 as the trade war intensified and as the Fed steadily increased short-term interest rates. The current rally, which I believe is a classic blow-off top, only began in late October when news emerged that a deal to de-escalate the trade war was actually in the works. In other words, like just about everything else in the president's economic win column, the stock market has been hugely affected and even undermined by the controversial moves on trade. Now, could the trade war ultimately still prove to be a win for the president? Sure, it's possible, but a lot will depend upon what happens between now and November. Coming up in just a moment, we'll talk about how the coming election could impact the markets and vice versa. Now let's welcome back our next guest, Jeff Small, president of Arbor Financial Services in Melbourne, Florida. Jeff is actually the brand ambassador for our very own retirement income store. He's also the Amazon best-selling author of the book, Turning Financial Planning a Right Side Up. Jeff, thanks so much for being back with us on the show, as usual.
Dave, it's great to be back. Thank you.
Now, this is going to be just a warm-up because I believe it's actually next week I'm traveling, so you're going to be my guest host here. But today, we're talking about the president. Re-election coming up in November. Will he get re-elected? Will he not? Before we get to that, tell our viewers what kind of grade, if you were a professor, what kind of grade would you give the president right now on the economy and why?
Well, I think I would give President Trump an A+ on the economy because the consumer hasn't been this strong since pre-2008. It's almost like the fireworks are going off because the economy is exploding just from pure consumerism. And I think that's more of a psychological effect of having a businessman in office as the commander-in-chief versus a politician. So I would give him an A+, but there's many reasons besides that as well.
Now, you're a little more lenient as a grader, I would say, than Peter Morici. Peter, as you heard, said he'd give him a B, a solid B. And I think part of that was because of the GDP growth. You know, we thought we were going to see great GDP growth. We saw it, getting up in the mid-3s, and it looked like it was going to get up over 4 as the president had hoped. But then it went right back down to a bit over 1%. So the average since the tax cuts has really been about 2.5. So how do you... What do you think causes that? You're right, consumer spending is strong. Everyone's acknowledging that. People feel pretty good. But why is GDP only growing at 2.5%?
Well, you have to remember, he came in after an 8-year expansion, which by any stretch of the imagination, historically is incredibly long without a contraction. And so it's really hard to get the economy to grow at greater than 3.5%, even though he's done it for a couple of quarters and even got over 4 in one quarter. It's really hard to do that when you have an aging population and you're late cycle in the expansion stage. And so, I still give him high marks for everything that's happened. And I think 2.5% is really going to be the new norm. That is going to be 4. It's kind of grandiose to believe that we could ever get GDP above 4%, late cycle, after an 8-year expansion. And it's just not realistic to think that you can do that. It's never been done.
But let me ask you this. So we've averaged over 2.5 since the tax cuts, but that's with this crazy trade war. How much higher do you think GDP growth would have been or could have been had we not had the trade war?
Anywhere from 30 to 50 basis points, that is shaved off of GDP. China's lost a lot more than that, but the trade war really had to happen. Somebody had to bring China into the fold and stop their abusive, predatory practices in trade. And rightly so. There was nobody that would have gotten this job done in 50 years. Trump leveled the playing field. And he also leveled the playing field with China by lowering corporate tax rates to 20%, which is the same as China's corporate tax rate.
Mm-hmm. Yeah. So speaking of that, we have 45 seconds left. Why is the tax cut perhaps the biggest economic thing that's happened during the Trump presidency?
Well, when the tax cuts came into play, about every S&P 500 company ended up with an extra $2 billion of net profit, which of course happened to help their earnings a lot. So since then, we've been a declining interest rate and a declining earnings environment and a rising stock market. So while these companies had this extra profit, they've pumped a lot of money back into their own businesses and they've hired lots of people. And that's part of the reason why unemployment's at 50-year lows. Yeah, it is at 50-year lows too. And we're finally starting to see wage growth now. Year over year, wage growth was up over 3%. We haven't seen that since before the Great Recession. So, Jeff, if you want to stay with us for a minute, please, we need to take a commercial break. And you stay with us also. We have more here to come right here on the Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. As I mentioned at the top of the show, just about everything that a president does or even says has the potential to impact the financial markets. We saw that at the very start of the year when the president approved a drone strike that killed one of Iran's top military leaders. In response, the stock market rally that began in late October stalled for a brief period of time. As tensions eased on the following days, then the rally took off again and continued with all the major market indices reaching new record highs and the president celebrating on Twitter. He should celebrate because if the current rally can continue to shrug off everything from Middle East tensions to recessionary warnings by economists to impeachment, and it keeps going up into November, that bodes well for the president's chances for re-election. Again, the economy is always one of the main issues on voters' minds when heading to the polls, and as measured by the stock market, job growth, and certain other indicators, Trump's economy is still quite strong. So with that in mind, it's certainly likely that the president will do everything in his power in the months ahead to keep Wall Street happy. The Federal Reserve has already demonstrated that it intends to do pretty much the same
with the quiet launch of yet another round of quantitative easing. Now, if you saw my 2020 market forecast show, you know this is why I'm forecasting that the current market rally could continue well into 2020 and possibly even into the beginning of 2021. It also helps that this is a presidential election year, which tends historically to be good for the stock market. At the end of the day, I still believe the current rally is most likely a blow-off top, which is a period of fairly steady market growth that occurs in spite of mixed economic data and recession warnings, and is often followed by a steep decline. Despite the president's optimism and the Fed's tinkering, there's no denying those warning signs do exist. Now, in addition to the decline in manufacturing and a stagnant GDP, even job and wage growth showed signs of slowing a bit in December. Also, let's not forget that the U.S. yield curve was inverted for a period of time in 2019, which is a classic recessionary indicator which forced the Fed to lower short-term rates 3 times toward the end of 2019. Even if everyone is ignoring these warning signs, the bond market isn't, which is largely why the yield on the 10-year U.S. government bond stabilized second half of the year between 1.5% and 2%. The logical bond market disagrees with the emotional stock market that the economy is strong enough to justify sky-high valuations. So which one should everyday investors pay attention to? Well, in my experience, when it comes to the most important financial decisions, logic always trumps emotion. Time to welcome back Jeff Small, president of Arbor Financial Services in Melbourne, Florida, brand ambassador of our very own retirement income store, and best-selling author, turning financial planning right side up. So Jeff, I guess it doesn't surprise me that you and Peter Morici are in agreement that you give the president not just a passing grade, but a high grade. I get that. But some of the negatives, you heard Peter talk about his concern about the president getting reelected, that he might not get reelected, in part because he hasn't done enough for the middle class. Now, you know the tax cuts have benefited the middle class a little bit, perhaps not as much directly as they have corporations. But what do you think about his comments about that?
I think Peter's not on the same planet that we're on. The average middle-class household has had a raise of over $5,000 in income just from tax breaks and increases in wages. That's more in 2 years than the Obama administration couldn't even create an increase over 8 years. And so there's only so much the government can do. People have to empower themselves. If they believe, as a middle-class person, if you believe that the government is going to save you and politics are going to be your salvation, you're sadly mistaken. But I'm sorry to see that Peter's not recognizing the true value there and what's happened to the middle class since Trump's election.
And the biggest thing is the stock market. So I guess to your point, if someone had the discipline to put some money into a 401k, to have some mutual funds, some money into the stock market, they'd be that much closer to retirement right now because of the tax cut and indirectly how it helped boost the market. Whereas conversely, if somebody didn't have that sense of responsibility to plan for retirement, then all they'd be feeling really is that extra little bit of revenue that comes in their paycheck every month, maybe allowing them to live a better lifestyle, but not really helping them reach their long-term goals any closer than before. Is that?
Well, look, those are true, very, very true. But things that impact the election, Dave, are things like inflation. And where is inflation? Is there any inflation? Peter forgot to mention that. That lack of inflation combined with the increase in wages and the lowering of taxation is remarkable for the American household. We're looking at closer to an $8,000 or $9,000 swing in actual consumption ability from the middle class. And so I think you're going to see that vote even larger than the November of 16 vote, where we're going to probably be around 73 to 75 million total votes garnered for Trump in the election.
We talk about inflation. It's funny. I was just thinking, you've been to my home and, you've seen I've got a couple 60-inch flat screen TVs I bought 10 years ago. And I think back to the fact that those cost maybe $4,000 10 years ago. Today, a few $100s. So it's also true that with technology, our money goes further than it did back then. We need to take another commercial break, Jeff. So again, please stay with us. You stay with us too. We'll be back here coming up in a moment with more from Jeff Small on the income generation. Welcome back. We're talking with Jeff Small, president of Arbor Financial Services, author of the best-selling book, Turning Financial Planning Right Side Up, and brand ambassador of our very own retirement income store. Okay, so the president appointed Jerome Powell. How good of a move or bad of a move do you think that was on behalf of the president?
Well, I think that, people forget that the Fed is not really part officially of the federal government or any particular branch. They're an independent entity. And so not every Federal Reserve chairman gets it right. I think that Powell made some mistakes in 2018 where he raised rates 3 times and then had to amend by lowering rates again in 2019 and get us to this point. But it looks like the Fed right now, it looks like it's a good appointment, Dave, because it looks like the Fed's out in front where they should be with Operation Twist and getting the yield curve to re-steepen and making sure the repo market is flush with liquidity. Because without their assistance right now, who knows where things would be.
Okay, so do you think then that interest rates seem to have settled in that 1.5% to 2% range on the 10-year government bond? You think they're going to stay in that narrow channel for the foreseeable future? Or do you see a big spike or a big decrease in interest rates?
Well, I don't see a big upward movement in interest rates. I think rates are going to be where they're at. If we stay at 1.8, I think the stock market continues to expand on the 10-year note. If we drop below 1.65, I see the stock market contracting, and that'll be an ominous sign that the yield curve is no longer steepening. And so I think if you're an investor, you really want to pay attention to that as a barometer for what the markets are going to do, because it will change sentiment. And we're just one small speed bump away from causing the market to drop rapidly due to the excessive valuations that we have.
So given that's 2020 now, given that the president wants to get reelected, given where the economy is, longest recovery on record, but yet still things seem to be marching forward, what do you think are some good New Year's resolutions that you hope and pray that our income generation viewers have made, financially speaking, for 2020?
Well, I think my resolution for all the investors watching would be to stay vigilant and understand that the stock market went up over 28% last year in a declining earnings environment, which means the net profit was shrinking on a month-over-month basis, but not as much as Wall Street wanted. This year, we're expecting a 1.7% decline in earnings versus last year. And if we stay in that range, the markets will grow. So you want to stay positive. Don't get overly exuberant and irrational and assume the market's always going to go up.
So be careful, be cautious at this point. After all, it is the longest economic recovery in history. So, Jeff, I think those are some great words of wisdom. That's why I always love having you on the show. And hopefully you'll have fun next week talking to our income generation members right here in the space. So, Jeff, thanks again.
Great. And it's all my wisdom hair that gives me all this wisdom, Dave, all this gray here.
I love it. You stay with us, too. We're coming back here in a moment on the income generation. We'll be right back. As I said at the top of the show, it's simply a fact that President Trump is entering an election year as only the 3rd president in U.S. history to have been impeached. That sounds like it should be a big deal, but so far, it doesn't seem to be. It probably won't be even once the presidential campaign kicks into high gear in the coming months. The Senate's unlikely to remove the president, and his staunchest supporters are likely to remain focused on his administrative victories and a strong economy, especially if it remains strong heading into November. However, if the main indicator of its strength at that time is still the stock market, while GDP growth, manufacturing, other areas of the economy have continued to struggle or decline, then perhaps the president needs to take heed. As I noted on my 2020 market forecast show, the 2 important questions for investors in or nearing retirement to keep in mind with regard to the stock market this year are, number 1, is the growth real or justified? And if not, do I really want to bet on something that's artificial in nature? Based on all that we've discussed today, I believe the current rally does indeed have all the earmarks of a blow-off top that is being fueled much more by artificial factors than by economic realities. These artificial factors, again, include more economic tinkering by the Federal Reserve, hope and optimism that the U.S. can still emerge victorious in its trade war with China, and that 4% GDP growth might still be possible. Maybe, kind of, sort of. Those factors could indeed keep the market inflated for some time to come, and that would certainly help the president in his bid for re-election come November. However, it's always better to focus on logic, not emotion, when it comes to financial planning. So, logically speaking, even if the president is elected to a second term, the financial markets still have to make fundamental sense again at some point. The sustained market correction that the Fed has managed to delay for years is still highly likely to occur based upon historical evidence. And when it does, some investors who get caught in the downdraft could risk losing between 40 and 70% of their life savings. Now, obviously, if you're part of the income generation, if you're in or nearing retirement, you simply wouldn't have the time to recover from a loss of that magnitude. And you would no longer have that money as a source of retirement income. So no matter who you plan to vote for in November, keep in mind that a financial plan designed to protect your money and to generate income is a sound strategy, regardless of who's in the White House. And it all starts with finding the right advisor. Thanks for watching. If you're close to retirement, you really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.